It's a really exciting year. It's the 10th year that we're hosting the Investors' Choice Awards, and it's been a phenomenal year. Just to give you a sense, to be in the top performers, the average top performing fund was up almost 30%, which is huge. And most strategies seem to do well, whereas in previous years, there's always been some strategies that have done better and some that have fared worse. On the whole, hedge funds did very well. And it's easy to forget what 2020 looked like, which is when this year, that's the data that we're looking at, is the year of 2020, the calendar year. I mean, with stock markets at an all-time high now, but the stock market hit, and the S&P hit an all-time high in February, then dropped by a third, and then rallied by almost 70%, and ended the year up 16 to 18%, depending on the index. So it was a very volatile year. The VIX hits all-time highs, and a lot of fund managers, not all fund managers, but a lot of managers managed to trade the markets very well. And there were opportunities everywhere. There were opportunities in relative value, in the event-driven space, in a lot of macro managers did well. Healthcare and biotech was a great sector. It was a really fun year to be watching the hedge fund industry, and I think 2021 will be a continuation of that environment for active management.
Ryan, it is important to rake over the different months and quarters that we had. I mean, the moves to the downside were extraordinary, and only a number of hedge funds were really well positioned for that sell-off. But then at the same time, many had to quickly shift those portfolios and move to the upside to capture the recovery, the rebound that came so swiftly. And then we had more of it in that final quarter around the fiscal stimulus. What did this also tell us about man versus machine, though? Because we've seen a lot of computer-driven strategies in recent years. Was it the year, though, for the man, because we saw such a swift move out there in the markets?
Yeah, it's an interesting question. I think by and large, discretionary strategies did better than systematic strategies. So most funds did reasonably well, but the best returns came from managers that reduced risk as they saw the pandemic emerging from Asia, and before the West had really priced that into markets, and then after the sell-off bought in at lows. Those funds, at least in the equity markets, tended to do best. And also just discretionary trades, to be short oil, to look for rates at the short end to fall further. There was a lot of volatility and room for, the volatility is generally good for hedge funds and most types of hedge fund strategies, but particularly quant strategies, whether it's trend following or statistical arbitrage. But the best returns came from discretionary traders just calling the environment correctly.
Ryan, there were obviously some spectacular outperformers, but isn't it also true to say, and let's just be very clear with our audience here, that most hedge funds actually performed the major equity indices?
I think most hedge funds match the indices. I mean, it's hard to match the NASDAQ, but the broader markets, certainly the hedge funds matched in terms of in terms of return, but they did that with a fraction of the volatility. And I think that's what's important.